name's Caron. I am the Managing Director of online and print publisher Medianett. I'm really excited to host today's session with Scott Apps and Rob Oliver of Castle Trust Bank. We are going to be talking about the topic of maximising investor opportunities in the holiday let market. We're also joined by a panel of excellent brokers who will shortly be introducing themselves. Thank you very much to all of you for taking the time to share your expertise and thoughts with us. Attendees have the ability to ask questions via the raise your hand tool on the platform, and we will certainly try to get to as many of these as possible throughout the session. So a bit more about the topic. The booming UK staycation sector is one of the few positive byproducts of the pandemic and associated lockdowns. Breathing much needed life into the economy, domestic travel is set to soar this year, underscored by the spike in second home purchases as investors prepare for the warmer months. Even farmers are increasingly looking at the prospect of diversifying into accommodation, owing in part to Brexit-related questions over support for agriculture. The popularity of holiday lets predates 2020 though, with yields doubling that of standard buy-to-lets in some cases depending on the region. But as with most sectors, COVID has altered the landscape for this asset class. There are stamp duty and other taxation considerations to take into account, as well as where is best to invest given the seasonal effect on occupancy rates and changing demands of travellers. Prospective holiday let owners also need to have a view to the stability of the market and a business plan accordingly, given that travel restrictions will eventually be lifted. It is reported that those booking staycations also have bigger budgets and are willing to travel further for that perfect UK getaway, emphasising the importance of being best in class in an area, something which Castle Trust will be expanding on a little bit later in this discussion. So we're going to be covering all of this, as well as how and where to source funding for holiday let acquisitions and the adjacent products that help facilitate this, such as bridge to let finance, covering experienced and first-time landlords alike. So I would now like to hand over to the panel to introduce themselves, starting with Rob, if that's okay.
Yeah, good morning, everybody. For those of you who don't know me, my name is Rob Oliver. I'm recently appointed Sales Director here at Castle Trust Bank. I've been involved in mortgages for just over 30 years with regional building societies, large banks, high street lenders, and for the last 5 years working in the specialist lending market. So fully understand the pain and the journey brokers go on every day. I'm looking forward to chatting to you today.
Thanks very much. Scott?
Yeah, good morning, everyone. My name's Scott Apps. I'm Business Development Director for Castle Trust Bank, looking after primarily the London region. Very excited to discuss this topic. It's growth, it's new, there's a lot of innovation that can take place in this area. So yeah, it's exciting to be involved in.
Thanks, Scott. Anthony?
Hi, I'm Anthony Rose, one of the founders and directors of LDNfinance. As a business, we focus on all forms of property finance, so residential and specialist, etc. The holiday let side has been a very large part of the business that we've been doing this year, and I think the growth that we've seen means that that will continue to be the case going forward as well.
Thank you. Jason?
Hi there, I'm Jason Berry, Group Sales and Marketing Director at Crystal Specialist Finance. Been involved in financial services not quite as long as Rob, so even though I've got probably as much grey hair, he probably top trumps me with his 30 years, but not far away from a similar amount of time. But obviously delighted to be part of this and to be talking all things holiday let.
Fantastic. Thanks very much, Jason. So let's just dive straight in. First, we're going to get a short background from Rob about Castle Trust's support for this market. It's quite historic support, it's not anything new, and it is an area that I believe the bank sees huge growth in. Rob, can you tell us a bit more about how you see the trends there?
Yeah, certainly. Castle Trust Bank have been fundamentally a buy-to-let specialist lender now for many years. It was interesting on our journey last year, as during the initial lockdown period, we actually converted from a true specialist lender to a bank. which obviously puts us in a very different position regarding our funding and our appetite. However, buy-to-let investments are at the centre of everything that we do and offer as a bank. So from our perspective, we accommodate and we see lots and lots of investors contacting us for various opportunities, whether that be HMOs or standard conversions or standard buy-to-lets. However, what we've noticed in the last probably 2 to 3 months is the huge spike in holiday lets. We see it as a massive growth market. We see it front and centre of the proposition we offer. And from our perspective, it's just understanding the profile of the client, because people want to invest and obviously generate a good yield whilst getting capital growth as well, and that door has now been firmly opened for both experienced landlords who are diversifying out of their standard range and looking very much towards increasing their proposition, increasing their portfolios into different markets, but also we're seeing an awful lot of increase in first-time landlords. We'll talk about the yields a bit later on. Obviously, the stamp duty holiday has created probably a false level of interest to a degree. However, the more sustainable investment opportunities are still there regardless of the stamp duty opportunities. So if you put all that together into the holiday let market, coupled with obviously the travel restrictions, which nobody quite knows when they're going to be lifted, it is generating a huge market at the moment. And I was just listening to the BBC news this morning at 7:30, and there's a big 10-minute article on the Southwest and the holiday let. So I think lots and lots of people are seeing an interest in it. Lots and lots of banks are now looking to get into the space. However, Castle Trust has been a predominant expert in this space now for a number of years, and we understand the market and how it's evolving. But the market has been there. Will it remain as strong for the short term? Certainly. And I think as people understand and they get out and see more of the UK and realise actually that the vacation that you can have within the UK it's just as good as going abroad. I know today's weather's wonderful. I hope it's wonderful where you are. I'm in the northwest, where we used to 6 inches of rain every day, and the sun is shining and it's 20 degrees. And I was told reliably on Twitter this morning it's hotter than Ibiza today in the UK. So why wouldn't you want to be in the UK?
Thanks, Rob. It is a beautiful day to be talking about this. Phil, hi, welcome. Can we hear you? Just going to check if we can hear Phil, because we would love to have him on if we can.
You hear me now?
Hi, Phil. Welcome.
Guys, I'm so sorry. I don't know. Poppy has been amazing. Poppy and I have spent the last 19 minutes trying to make this work. So anyway, we're on. So thank you very much for having me. And sorry, I'm late.
That's okay. Phil, do you want to give us a quick introduction of who you are, and then we'll continue?
Yeah, sorry. So I'm the managing director at Watts Commercial Finance brokerage covering the whole of the UK. We do a lot of holiday lets and this type of finance. I'm also interested as well because I'm a holiday let owner. So interested to speak from both sides of the coin. And we broker somewhere between 30 and 40 million pound a month finance and offices all over the UK.
Thank you very much. So jumping back into what Rob was saying about his views on the market, Jason, does this chime with what you're seeing from a brokerage point of view?
Yeah, look, I think the Ibiza thing was interesting there, because I'm blessed. Probably back in 2003, rather than investing in the UK market, I actually invested over in Spain, which seemed a great idea at the time. But when I look at the last 12 months and see that we probably only had 1 week possible in actually being over there, it probably doesn't look as clever now. So certainly that restriction of international travel is certainly helping the holiday let market. And at Crystal, we're definitely seeing an increase in demand for clients wishing to capital raise. And I wouldn't necessarily say it's specifically the investors who are looking at the holiday let market at the moment. From our perspective, it's tending to be customers, consumers who have maybe got sick of the four walls they've been looking at during lockdown, and they've got a spare bit of cash, and they're looking for that summer retreat and that weekend retreat. So we're not necessarily seeing it from an investor's perspective just yet. And I think as we go through the discussion, we probably talk about some of the reasons for that. But we certainly see an increasing amount of capital raising transactions, and certainly contained within that is the holiday let product.
Thanks, Jason. Scott, is there anything you would like to add to this introduction from the bank's point of view?
Not too much. I think Rob, Jason, and Phil have covered most of it. It's a growth market. We're excited about where it can go, about the development in the economic areas, the localized economic areas that it speaks to, as well as the opportunity it presents for possibly less experienced investors. Obviously, we can help with those, but like Jason alluded to, it's people who are sick of the four walls, but they're understanding the opportunity for return on capital invested, and it's a growing investment area, so it's very exciting for us to be able to support that.
Wonderful, thank you. Anthony, I recall us having a conversation in September about how you viewed this part of the market, this asset class, to be something worth watching, especially with the changing values of people owing to lockdown and COVID. What sort of info or intel can you share with us about specific areas and locations that are particularly ripe for investment right now?
Yeah, I mean, obviously we're a London-based firm, so I think a lot of the inquiries that we've had, which is more therefore on an anecdotal level, is where London-based consumers would want to buy. So we've seen a lot of stuff for the whole of the South Coast, going down to sort of Devon and Cornwall, and then again going up to sort of like the Norfolk areas in the UK. So that is where we've been very much focused. I think I saw on the news week before last that Cornwall on Rightmove was the most searched for sort of location for whatever period they were looking at last few months, and ordinarily it would have been nowhere near, I would imagine, but it's not surprising based on the fact that people are having the combination of not expecting to be in the office so much, having greater flexibility on where they can base themselves, that both as a main residence and obviously as this topic is covering as holiday let investment, that those areas are going to be, you know, extreme growth areas. I think all of the desirable holiday locations are where the holiday let market is going to be for definite.
Thanks a lot. Phil, as someone who has a holiday let, could you maybe share with us a few, you don't have to tell us exactly where it is if you don't want to, but maybe share with us a few details about what one needs to consider before you know, expanding one's portfolio into this space?
I think it's really interesting, and you know, some of the guys have picked on some great points. Is though I think there needs to be a clear definition between people who are looking to buy a second home that they will also then rent out to cover some of the costs, as opposed to I mean, I'm fortunate, I've got it, but I don't even rent it out. I should let friends and family use it. But then, whereas if you've got somebody who's then buying one as an investment, because my worry for people who are buying them as investments is that these are a completely different animal to a buy to let. I did an example this morning where we looked at one that was £295,000, and the headline rate was that it generated £30,000 a year of income, confirmed by Sykes, which gets a buy to let investor very, very excited. Apart from that, when you actually then take off the running costs of running that buy to let, the actual profit was 7,700 before tax and before any repairs or renewals. And bearing in mind, when people go to a holiday home, they leave the electric on, they leave the heat on, especially in the winter because they want to be warm. Things get broken, plates get damaged, dishwashers get broken. You know, so I just think investors have got to be very careful that they understand what they're getting into, because and you've got to be very careful just looking at the headline rate of income versus the actual costs of running it. It's a business, and when I look at them, it's almost like looking at profit and loss. So to answer your question, mine's in Abersoch in North Wales, which is very popular and very trendy. And I think, you know, holiday let homes are great, and yes, there's a boom for them right now. I think what people forget is that they are actually a home, and all the jobs that you need to do on your main home, you also need to do on your holiday home. And I sometimes get down to Wales and think the first 3 days of my holiday, I'm actually doing jobs where if I was sat on the beach in Greece or Spain, I wouldn't be, because I'd be on holiday. But I do think the clear definition needs to be made, and I think this is where both investors and lenders can get into trouble, is that there has to be a clear definition between somebody who's buying a second home that they'll rent out to subsidise the costs versus somebody who is buying this purely as an investment vehicle. And I think that's where then people have got to be very, very careful that they're not starstruck by the headline amount of income. They actually would do the work and drill down and look at the actual running costs of running one of these, because it is a business, it's not a buy-to-let.
Thanks for bringing that up, Phil. Scott, is there anything that you would like to respond to in that before we head into the, I suppose, the more favourable aspects of this type of investment?
I'd just say I completely agree with Phil on that point. They need to be completely aware, educated. That's where experienced specialist brokers add a lot of value to this this area of the investment market, is because they can educate a fairly inexperienced investor who, like Phil says, is seeing the shining lights of a huge amount of income, but probably not acknowledging this considerable costs, and actually probably the unknown costs or the fluctuating costs. You can't predict necessarily how much it's going to cost you per year to run it, because the variables are too wide ranging. So yeah, being pre-warned, pre-educated, and knowing exactly what you're getting into is absolutely important, and we would expect that from any investor who's looking to borrow from us on holiday let.
I think giving investors some confidence around I suppose the reassurance of the competitiveness of the products are there at the moment, and I think the kind of reassurance they want tends to be just around the areas that are, I suppose, difficult to provide reassurance on. So it's around the UK employment, which nobody knows. We can make predictions, but nobody knows what it's going to do over the next 6 months. And then also the impacts of easing of the travel rules. If the travel rules stay fairly tight, then there's an opportunity, providing the locations picked and the products right, but there's an opportunity for somebody to have a quite an explosive summer period if they purchase now. But it's just it certainly needs persuading and influencing and educating if we're to get more investors on board.
Thanks a lot, Jason. I believe that Dak from Sirius, who was meant to join us today, I think that we have him on audio, so I'm just going to see if I can get him to connect quickly, and we can just say hi and get him involved in the conversation. Dak, if you can hear us, if you can unmute your microphone, that would be great. Okay, we'll see if he can join us in a little bit. Scott, I wanted to just come to one of the points on our discussion agenda around the taxation around this particular asset and holiday lets. What sort of considerations should an investor have here with regards to how these tax rates and setups differ from a standard buy-to-let?
Well, this is probably one to actually throw to the brokers, because we have our stance, but then there's some other elements that would be involved from an advice point of view. I would say just be very aware of exactly what the tax implications are, as Phil alluded to, with if you've got a second home which you are letting out to cover costs, the tax is different to if it's a purely investment property. And then again, if you're buying it in a limited company, then the tax implications are different in terms of what you can write off against running costs, etc. So it really is quite a minefield for someone who's not done their due diligence in terms of what taxation applies, when and how, and what you can do up front to make sure that you're well informed and make the right choices for you. If you're an existing property investor who's got a large portfolio, then it might be that one option is best for you if you're just buying another property into a limited company. Whereas if this is your first investment property, you're intending to buy in personal name, that's going to look very different. So I'd say, yeah, get the right advice. I don't know if any of the brokers on here want to pick that one up and explain how they would approach that.
I think the other point to bear in mind as well is the difference between council tax and business rates. In North Wales right now, we just had 100% premium put onto our council tax because it's a second home. Now, obviously, if you've got it rented out for 20 weeks or more, then you're eligible for business rates, and you can move from council tax to business rates and then get small business rate relief, and etc. etc. So again, it's quite important that the investor looks at that as to whether is it a second home or is it purely a business function. to make sure that they qualify for the right. I mean, I know my council tax now in North Wales is £4,400 a year, which is, you know, for a 3-bedroom holiday home is ridiculous. But it's just about taking those points into context, because I think, don't get me wrong, I think they're a good investment. I just think people need to go into it with their eyes wide open and understand the costs. And I tend to think, having been a commercial banker all of my life, I tend to think of a holiday let as a P&L lend, whereas a buy-to-let is an AST lend in terms of the rent because of minimal costs. And whenever a client comes in to see us about a holiday let, we will sit them down and look at it like a profit and loss situation, not just look at the rent. So I think, you know, the taxation and the council tax versus business rates is really important, that people do their homework before they embark on an investment, and you know, look into it and do their research.
Thanks a lot, Phil. I'm going to move on to it's another question for the brokers on the panel to talk about the appetite from funders and financiers for this product or for this type of property and investment. What does the appetite look like, and what are you looking for from a holiday let product? Does it exist? Do you want more? Anthony, can we start with you?
Yeah, so I think a few points have already been made on this, but I think the way that the pandemic's unfolded, I think it's really important that going forward, the consumers themselves and the lenders differentiate between the different types of people that are buying holiday lets. So without remaking the same points, you've got people who want to buy it to use themselves and maybe let occasionally, informally or formally, and sort of really just have a free holiday home because their costs are being covered. And then you've got the other end of the spectrum, which is someone who might want to buy a property and develop it into multiple units and holiday lets and everything in between. So I think probably as much as any part of the mortgage market, there is a need for understanding in many different types of finance. I think the thing we've seen a lot of from a consumer demand perspective is the ability to take a relatively high leveraged product and have the ability to have a combination of staying there themselves and letting it out. And there are some residential lenders that allow that with a bias towards staying there more than you let it out. And then there are some specialist holiday let lenders that work on the reverse. So I think going forward, there is definitely room for innovation on that side to try and have sort of a hybrid usage product, which they are there, but I think there is more demand for that. We have definitely seen as a firm, and that may not be representative, but we've seen as a firm many more inquiries for that type of setup than the sort of super professional holiday let landlord in a limited company who is looking to maybe buy 3, 4, 5, 10, you know, however many units. So I think there's definitely demand for that as well. But I think the knee-jerk demand that we're seeing at the moment, which may or may not stay once the pandemic disappears to whatever extent it's going to, has definitely more been focused for the sort of consumer end of the market rather than the specialist end. So I think you're seeing a lot of the smaller building societies fill that space, but they can be quite particular with their criteria and the way that they want to work. So I think there is a big opportunity for the funders, you know, whichever part of the market they want to move into, to fill that gap. But I think it's a really sort of grey area and potentially dangerous areas for consumers where they get their setup wrong, they take a mortgage product for them that does not fit, and they're either falling foul of the terms and conditions of the mortgage by staying there when they shouldn't be, or that they've got something that doesn't fit the sort of risk profile that the bank is expecting that they're taking on.
Jason, would you agree with that? Do you have any additional?
Yeah, I think, I mean, kind of linked to Anthony's point there is, you know, I think if we look at the most successful and the most regular, I suppose, supporting professional investors, they tend to be those that are really skillful at converting property use from one type to another. So I think, you know, if you look at the inflated marketplace we've got in terms of, you know, maybe pricing on these coastal towns that Anthony mentioned earlier, I think, you know, professional investors are always looking for bargains. And I think the more types or the more flexibility we can have with the various fundings which allow flexible conversions, I think the more appetite there will be with the actual investors. So I think we will see some trends changing and improving, and we're already seeing some lenders, as I said, it's probably the most competitive in terms of pricing criteria it's been, and there is some real flexible underwriting options out there now. So I think being able to convert the use and change the use is something that will I think make a big difference.
Thanks very much. I'm just going to try and see if we can get Dak on. I believe that he has joined us. Just going to see if we can get his views on this. Okay, I have asked him to just speak up when he's ready. So over to Rob and Scott. What I understand that you've seen an uptick in demand for your bridge to let offering. Can you speak a little bit more to that?
Yeah, so I mean, I'll feel this. I'm seeing possibly more the front end inquiries than Rob might. So we see a lot of people looking to either improve an asset that they can get hold of. So there's the areas that people are looking at are slightly more wide ranging. There's a few different market factors we think are influencing that, but then you've got what they intend to do. So whether it is conversion of what used to be sort of a small B&B, so still strictly speaking residential usage, but they could split that into 3 holiday apartments or convert it into sort of one large seafront holiday let, so it's like a 6-bedroom family home. One of the biggest influences in the market now is that people are heading towards self-catering because they want their own facilities. Even B&Bs and things like that, you're sharing facilities, and for all the previously known reasons, people want their own space, their own facilities, their own area, and not to have to sort of share anything with other family groups. So it's the self-catering market that is driving this refurbishment angle, and so yeah, people want the high leverage, as Jason mentioned, or I think as Angie mentioned. They want the high leverage so they'll be able to do the work, and then the yield will definitely cover a loan of say 75%. And we can facilitate that, and we see a lot of that for first-timers and experienced investors. So it's changing the asset to be what the market is after at the moment, and that leads to properties slightly outside of the hub towns and cities, more towns obviously if it's sort of coastal and rural, maybe the lakes, the peaks. People are quite happy to take on properties that are a bit out in the sticks that maybe might not have been so popular. People actually now want that. That's now in demand. So if they need updating, improving, whether they're going after getting them to be best in class, so you're installing hot tubs and extremely high-end fittings and fixtures, that's one angle. The other angle is to make the accommodation extremely useful and get as many sort of bedrooms in as possible. The bridge to let angle, the refurbishment angle is definitely there for all sorts of investors, and we're seeing that's what's it's reacting to the market and having the ability to react to the market and create a product that would be popular.
Thanks very much for that. Phil, is there anything you would like to add in this particular area about specific product types that your clients are using to get this off the ground for them?
No, I mean, I'd echo a lot of the points. So our automatic lights are just going out, so I'm in the dark. There they go back on. No, I'd echo the points everyone else has said. Obviously, a lot of the commercial, we've seen quite a few of the commercial lenders sort of stick into sort of lending against AST value, which really doesn't reflect the market. Because as I say, I do think it's P&L, but no, I'd echo what everyone said in terms of that. I think the points that have been made about the professional investors have been in the holiday let market will have been professional investors pre-COVID and will be professional investors post-COVID. I do think the danger with the COVID rush is that potentially come 2022 we'll all be desperate to get on a plane. So you could end up with some customers who are less experienced investors who've suddenly got lots of voids and lots of empty weeks because no one's gone on holiday for 2 or 3 years. So I think it's just that balance. I think Jason's mentioned the investors that will buy units and split them and multiple unit apartments and holiday apartments and everything. I guess those guys and girls were around in 2019 and will be around in 2022. So I think it's just about understanding the marketplace as we sit today based on this very unusual world, temporary world that we live in.
Thanks, Phil. Rob, is there anything you'd like to respond to there?
Yeah, I think just on the back of Phil's point now around people going into these transactions with their eyes open, one of the areas that we've seen on the bridge to let is where clients are purchasing an asset. As Scott's rightly said, we're seeing more and more conversions into higher end type properties, but whilst they're doing the conversion, obviously if they're the less experienced landlord, they're going through the process of looking at the tax implications, as Phil's rightly pointed out, looking at the management, looking at the potential council tax versus small business rates, etc. But what we're seeing is, whilst all this is being set up, we're seeing people remaining on the bridge on a rolled up basis, because if they bought the asset for sort of 200,000, they bridged out to that at say 75% LTV. Whilst they're modernising it, obviously they don't have any customers paying any rent during that period. Therefore, if they go onto a standard term product, the clients actually end up having to service that loan with no income coming in. And we're seeing people take the bridge probably 6, 7, 8, 9 months, just whilst they run their business, as Phil says, and get in the black from a P&L perspective. So 2 or 3 months of clients actually paying money in, and at the point where they've got a reasonable capital reserve, and as you know, as pointed out by the other panelists here, where they've got to get the cleaners in, if they've got to change the sheets once a week, they've got the heating bills, they've got a good amount of capital reserve, then they're flipping it over to a term product. And that innovation around that particular section of the market is allowing the lesser experienced investors to actually get a business and get it up and running, and it's sustainable, rather than having to immediately make mortgage payments. So from our perspective, the average sort of gestation period of the bridge to actually convert to terms is probably about 7 or 8 months. And that product at the moment is getting a fair amount of traction with ourselves. So it's not the traditional use of a bridge, but allowing the bridge to be used in this way will allow investors to sort of get themselves on the ladder and actually be able to run a sustainable business with capital in the bank as well.
Thanks very much, Rob. Just staying with you and looking a bit more at the nitty-gritty of applying for this type of funding. It's obviously been quite an intense period of scrutiny across the board for applications. As a lender, what's important to you to see in an application for this type of finance? What are the pitfalls as well for those who might be putting these forward?
Yeah, I think, as Anthony alluded to a few minutes back, it's around sustainability and plausibility. Now, you know, I won't embarrass Jason by asking him when he started mortgage lending, but it was a similar time to me, so he can't claim he's less than 30 years. But I remember assessing mortgages, you know, many years ago, and those two words used to come out: sustainability and plausibility. Does it work? Does it make sense? Can the client afford it? So you apply that simple logic to underwriting any mortgage case. So if you look very much around, let's say, a first-time investor, because we're comfortable in that space, they've got to have a good management company. They've got to understand the costs, as Phil said, but it's not just the costs of paying the mortgage, it's all the associated costs. And I think people underestimate, and the point when you're booking a holiday let in October through to February, as Phil said, the heating will be on 24 hours a day. If you've got AC available in your apartment and it's a terribly warm day, it's just like when you go to Spain. You arrive there on Saturday morning, you turn the air conditioning off, you turn it off again in 2 weeks' time. So I think it's understanding all the costs involved. And then the other thing we really focus on is having a good management company, because if your client doesn't live within circa 20 miles of where the asset is, realistically, how can they go along and do urgent repairs or go along and run the property as a business? Because it's not sustainable if somebody, for example, lives in London, as one of Anthony's clients does, and they want to take something out in Northumberland in Harry Potter land. It's not sustainable to nip up there if there's a leak or the heating's not working, etc. So I think for us, that the first time investor, very much good management company, understanding the costs, understand the tax implications, and then the one thing we want to see is, as a lender, is making sure that there's a good track record of bookings. Now, from our perspective, if you are purchasing an asset, you've got to be in an area where that actually that there was going to be other holiday lets that are sustainable. So, you know, we've spoken a lot about the southeast and southwest. Let's talk a bit around the northwest, and let's talk about the northeast, you know, and the Lake District, you know, good historical heartlands. You know, as a lender, we have seen the odd holiday let land, and I believe one landed in our lap last week in Birmingham. I'm not sure many people want to go on holiday in Birmingham. It's lovely, don't get me wrong, but I'm not sure it's in the top 10 holiday locations of the UK. So again, it just falls in around that. Does it make sense as a lender? And then I think when you get to the more serious investors, and Anthony's point was a good one, we don't see people who've got massive portfolios. We see people who've got 3 and 4s and 5s wanting to go just up a couple more. Well, actually, they've got their own management company and the locations work. They've got a good track record of booking. They use some of the sort of aggregator sites for consolidation of holiday let bookings, and they've got properties already on there. That then is a slightly different underwrite because, of course, they're running it as a whole business. So I think from a lender, it's not fundamentally different than the points Phil made is let's look at the income, is it sustainable? Let's look at the outgoings and does it make sense? And then the profile of the applicant is an interesting one because we tend to see applicants who really want to take their modernization. I think you used the word previously, best in class, Caron. I think we want to take, you've got people who are the real luxury end of the market, but also the spaces in different parts of the market depending on affordability. You know, you look at some of the prices of some of the centre park type locations at the moment versus some of the seaside locations, and I think there's gaps for everybody in the market. And up until the point that Jason made regarding the pandemic ending, these are turning into be incredibly popular. So we're seeing strong levels of booking. So as a lender, it's not a dissimilar way to assess that, but it is more of a business transaction.
Thanks very much, Rob. Jason, just
Hi,
coming.
Caron, can you hear me?
Oh, hello, Dak.
Yeah, sorry, I've had a terrible time with the internet connection, but I've listened intermittently, so I do apologise. But from my perspective, listen to what you guys have said. My job, I'm an associate at Sirius now. I always look at the lending, and one of the problems that I do think that some people have is considering not just the holiday let and the aspects of it, the income, the profit, the loss, but I do think that some people do struggle with, one, the lending, and two, the decision whether or not it should be limited company or in personal names. And one of the challenges that we've had as a broker is we get a lot of people who will go to an unregulated lender for a holiday let, but what they want to do, they also want to enjoy that holiday let themselves for 1-2 weeks in the summer, possibly a week over Christmas. And Scott, perhaps you can interject, but with the likes of Castle Trust and various banks, whenever you have an unregulated loan, be it personal name or limited company, the expectation is that the individual who finances it cannot stay in the property. And we have found that as a challenge, whereas my interpretation is for limited company lending, which is an unregulated loan, would a way around this be to allow the tenants to perhaps rent off their own limited company? Because I've got no doubt that many people in the past have probably breached the rules. But it would be nice if that could be something that would be corrected going forward.
Yeah, Dak. So yeah, strictly speaking, as it stands, if you are borrowing from us in particular, then it would be on the basis that you are not going to be staying there yourself. I'll pick up on that regulated point around if it was only a limited company and confirm, but as far as I understand it, it would be on the basis that it is an investment only property, and the owner effectively cannot reside. But yeah, and I imagine I understand we're the same as many others in that respect. And then various building societies and more mainstream lenders have a bit more flexibility in that, in terms of assessing maybe personal income against the lend, as it were, and therefore they're aware that they're going to let it out partially and stay in it partially.
Yeah, no, it's not so much a Castle Trust thing, but it's more of a market thing, to be honest with you, with non-regulated loans. And I do like listening to. I think there's been a lot of talk about Cornwall, etc., which I understand is beautiful. But I've experienced quite a lot of people who have looked at the Airbnb route, and they're looking for lenders who will lend, in all honesty, Birmingham, joking aside, because you know there is like businessmen or there's individuals visiting family who are looking for an Airbnb type stay where they can come and stay for a couple of days and then go. So I think that's a large part of the market that I would also see coming across my desk all the time, opposed to just the dream home beside the beach that costs X £100,000. So it has been interesting, and we've seen an increase in landlords looking to add to the repertoire, where they can add a holiday type let that can also be multi-purpose. So it could be used as an AST, but they do see the advantage in increased incomes and increased tax benefits, certainly for property owned in personal name, if they were to convert. So we have, we have had quite a lot of inquiries regarding this type of business also.
Thanks very much, Dak. I just wanted to pick up on a point that Rob mentioned about evidence of market and track record of bookings. We're obviously in a period now where that may be quite challenging to determine, given the fact that much of the market's been closed for the best part of a year. Jason, could you maybe speak to what you're doing now with clients to tackle that part of the requirement? How do we evidence a market that's been shut down for a while?
Look, I think it's difficult, and if you look at our role as a specialist distributor, I suppose, is to gather all the facts and have enough grounds to actually help a broker or a customer actually best have the chance of the deal being placed and completed. And I think just yesterday I had it was one up in the northeast. And just from a trading perspective, Caron, if we looked at the last 12 months, it was reducing EBITDA, it was a reducing turnover, and that was March set of accounts, and all it can have done over the last 12 months is worsen. So I think there are times where we have to say it's not a not ever, but it's just a not now, and we'll be quick at delivering that. That response. So as much as we want to get every deal placed, it comes back to, I suppose, right at the beginning, maybe done a full circle. The plausibility and the affordability have to make sense. And as I say, it may be a not now, but just not ever.
Thank you for that. We don't have too much time left, but I very much wanted to come on to the topic of foreign and expat investment in holiday lets, because we have a big tax move happening in a couple of days' time, additional stamp duty becoming applicable there, and I wanted to see what's the demand like from non-UK buyers and landlords, and what's driving that, if it's going up, is it going down, or what's the situation? Phil, would you like to give your thoughts on that first?
Yeah, I mean, we've not got a lot of it. We're not seeing a lot of overseas clients coming to. We're seeing a lot of overseas clients coming to us to buy property, but not necessarily holiday property. So it's probably not something that we've seen a great deal of. Just one thing, just going back to Dak's point a minute ago, one interesting thing that we've seen in Abersoch is the demise of the guest house. So the lack of demand for the Airbnb product in the holiday let locations. Most of the hotels and guest houses now in Abersoch have closed and have been converted into holiday homes. So I think whilst Airbnb is a definite product in different areas of the market and the UK, it's not something we're seeing in the holiday locations. There does seem to be a definite shift to the rental of a property for a week as opposed to a 1 or a 2 night stay. So that was just picking up on that point earlier. But certainly from an overseas point of view, we've got lots of overseas investors, but no real experience of overseas investors coming to us specifically for holiday lets.
Yeah, I would say the same thing. Yeah, but Caron, one of the things that you mentioned about the increased stamp duty for foreign investors, there's a very simple way around that, and that is to buy in a UK limited company, regardless of being a holiday let or return investment. So I think there will be an even larger shift for foreign over national investors, where they will simply open up a limited company before they initiate the purchase. But I do see a little bit with regards to Airbnb, but I've never in all my time seen a foreign investor wanting to buy a beautiful house in Cornwall.
It's a good thing, because they're not really fans of that at the moment. Rob, I just wanted to pick up on some of the reports around Brexit possibly driving the expat community to look at UK investments as opposed to ones elsewhere. just because of currency and tax implications that have now changed, and possibly it's not as lucrative as it was. Can you tell us a bit more about that?
Yeah, certainly. I think we're kind of on Phil's line here, that we're not seeing as many foreign nationals as we are seeing expats. However, we are seeing a reasonable amount of expats. And to be fair, one of the things we advertise as a lender is we are comfortable engaging with expats. So you probably get a disproportionate amount of them, to be honest. Hence the reason you can put a lens over them. So I think expats very much see Britain as still a safe place to invest. Britain's always been very proud of its home ownership, and I think they're quite traditional in some of their values and investments. So I think that's probably why we get the number of inquiries. And I think, as Dak was saying there, buying in limited company and a potentially other complex transactions, what lenders need to understand is that they actually understand beyond the complexity of the transaction, understand how it's made up, but without penalising these clients through incredibly high rates. Because just because they're not actually presently in the UK, it doesn't mean that actually they're a higher risk. Because as I go back to Phil's point of running a P&L, you've got to be able to make sure that the property is sustainable through the income it's generating, and obviously the asset itself. And that's another point that Phil raised there regarding the guest house demise. And again, what one of the big uses of our bridge product is to actually convert that into self-contained units, because people want that more. But I think when investors or expats are looking to invest in the UK, the buy-to-let, as you say, is stable. Dak's point on Airbnb, yep, I understand that one as well, and people are looking at that depending on where you are in the UK. But I think yield is still a concern to overseas investors, whereas historically, though, the capital value was the primary goal. So therefore, it was bringing in other assets regarding HMOs and holiday lets tend to give a bigger yield. And of course, the location in the UK as well can have a big effect on that. So I think from our perspective, the key thing is understanding how the transaction is put together as per Dak's point, and then making sure that the rate the client get isn't extraordinarily high based on potentially penalise them for not being in the UK. And then on top of that, the points we made previously around the sustainability and plausibility in the management company, and understanding what the actual costs are investing. And then if you add all those together, I think the increase in potential tax, depending on the structure of the purchase, obviously it tends to get swallowed up in the whole transaction over time, because these people are looking for long-term investments, not just a short-term win. So I think putting that together, the expat market we're seeing is remaining to be quite strong. The foreign nationals is probably not as busy as it has been.
Anthony, is there anything you would like to add to this particular section of the conversation? I'm not sure how many of these sorts of clients you have.
Yeah, so as a firm, we do have a lot of expats and foreign nationals, and to echo the previous points, for buy-to-let investment and sort of UK-based residential investment, if they're super high net worth and want a place in London to use for family, but not to be seen on the holiday let market at all. I think it's too involved a transaction. Rob made a good point that you wouldn't want to travel 200 miles to fit a light bulb, but they definitely don't want to travel 1,500 miles to fit a light bulb. So I think we haven't seen any demand really for overseas people, expat or foreign national, wanting to do holiday let. But on the buy-to-let side, it's been relatively constant. And I think where a lot of other countries are having various different degrees of problems with coronavirus, our housing market has been quite stable, so it's probably offering a bit of sort of safe haven appeal for people that had previously been looking at it. If it's something that was on their radar anyway, there's probably not a reason to not go ahead with that purchase. So we have seen a large amount of expats and non-residents wanting to carry on the buy-to-let side.
Thank you, Anthony. We're bang on 12 o'clock. I just wanted to see if we have any final thoughts from the group, and to thank everyone very much for attending and for bearing with us as we have people pop in and out with audio. So Dak, if you're there, is there any other final words of wisdom or experience you'd like to leave us with?
Yeah, I think that on top of just the location, I do think one of the most important things for individuals to do is, if they do want to buy a holiday let, people buy it for investment purposes or for the dream home. but they should always speak to an accountant about how they should buy it and what the advantages are between personal and limited company name, because it does differ from person to person. And they should also then speak to a broker, as I mentioned, with limited company, which is an unregulated loan. They should also check whether or not they are allowed to occupy the property. With regards to Castle Trust are great, but with most unregulated lenders, there is different quirks with different lenders as to what you can and can't do. So I think that's the starting point before you go out and fall in love with the property, which is not a mistake because it's understandable, but it's what people do. They do it back to front, but the tax advice and the lenders should really be looked at before you go out and fall in love.
Thank you, Dak. Phil, last comments from you?
Just two things really that I'm not sure whether we've touched on today. One, I think holiday lets are very, very difficult to make work on a capital and interest basis. So it is literally the clients getting a return on their money in terms of the return on the investment as an income, and gambling on capital appreciation, because they are difficult to make work on capital and interest basis. And secondly, just I think there needs to be some caution around stock. We bought a new holiday home about 5 or 10 years ago, and when my wife and I looked round, what you would live in and what you would holiday in are two very different properties. And I think the main areas, I think it's just important, and especially while we've got the pandemic on, that people in this mad rush because they think it's a great investment don't buy the wrong stock, because as the pandemic eases and we go back to a more normal holiday pattern, you could suddenly find yourself with a holiday home that no one wants, because you want to be able to walk to the bar, a pub, or walk to the beach, or walk to the restaurant. You don't want to have to get into your car. So I think it's important at the moment that people look at the right stock. And as I say, it's important they look at it in terms of why are they doing this? Because as I say, with the income and expenditure, it's difficult to make it work on a capital and interest point of view. So you have got to be looking at it in terms of a return on your money each year in terms of an income, and then also gambling on capital appreciation.
We will definitely look at doing a part 2 to this discussion and bring some of those points in, Phil. So thank you very much. Anthony?
I think it'll be interesting to see what happens over the next year or so as we come out of the pandemic, and whether it's been a bit of a stampede of people who see the benefits of having a holiday home for themselves, and to what extent they remain in the market and carry on. So I think it's been an obvious buoyant year for holiday lets in all of the guises, and I think it will be interesting, as I said, to see what happens over the next 12 months, and whether there's enough market for a conversation again in 12 months time, or whether it's petered out because people, as Phil said, want to go abroad and not stay in the UK as much.
Jason?
Yeah, look, I think echo those points really. So competitive solutions are undoubtedly available, and just understanding the circumstances is vital. So I suppose we've all got a duty of care to help ensure that whether it's the brokers we're supporting or whether it's the consumers, the investors directly, that we're just helping educate them so that they can make some good decisions. Yeah.
Thank you very much. Scott, over to you.
Yeah, I think all the thoughts around sort of the sustainability and how viable the market is for the long term are very warranted. I would say there's probably 3 elements for me that suggest it's going to be here to stay, at least in an improved form. There might be a slight tailing off, but I think it will be a sustainable, larger market for the UK staycation. I think that this period of time has seen a vast improvement in the product. As Phil mentioned, you need to have the right product for people to want to go and stay there. So whether that's in the right place or it's the right actual house, like it's very nice to stay in. He rightly mentions where you live and where you want to go on holiday and spend that time and that money, and it matters a lot. So I think the improvement of the product, along with the basket spend, to use a retail term, so people are willing to spend more on staying in places in the UK, especially if they're higher end. So the improvement of the product will lead, I think, to a more sustainable market. You've also got the uncertainty of overseas travel, especially in the very short term in relation to health issues. But you've got the uncertainty of that travel and the destinations that you might be going to overseas. So therefore, certainty is key, and the UK provides you that, both in terms of the health issues, but also the ease of travel. I think the fact that you can, especially for people with kids. I mean, I have a 1 and a bit year old, and the idea of loading all his stuff into an aeroplane terrifies me. quite happily throw it all in the back of the family SUV and off we go wherever we like. So I think there is, for families as well, for an improved product with a certainty of travel and destination and ease of travel, I think that will become more of a norm ongoing. So I think it is a growing market. I think it is here to stay, at least in some format, in a bigger way, and we're looking forward to supporting that as Castle Trust Bank.
Thank you very much. And Rob?
Yeah, finally for me, I think just directly aimed at brokers is don't be afraid of them. I think they're a transaction that a lot more people are going to see, and it should come across your desk a lot more. So don't be afraid to go market for them, but speak to experts. I think Dak's 100% right. You need to speak to an accountant, work out what is the best way for you as an individual to actually do that transaction, and then go and speak to a broker who is an expert in that field. There's some good opportunities, but as Phil says, it's got to be a longer term opportunity. So I think, to me, the market is here, it will stay, and people should see it growing and as a good opportunity.
Thank you very much, Rob. So that just leaves me to say thank you very much to the panel, and especially to Rob and Scott from Castle Trust Bank for supporting today's webinar or virtual roundtable. I think the discussion's been fantastic. We've had several questions that have come in, which we will hopefully get the chance to answer in a separate session. So yes, thank you, and thank you to everyone for tuning in. Once again, thanks for bearing with us on the tech issues. We hope you enjoyed the conversation, and we'll be tuning in to our next one, which will be next week. So thank you very much, and I hope everyone has a wonderful rest of their day. Thank you.
Thanks, guys.
Thank you.
Thank you.
Cheers.